Good afternoon. Thanks for joining us today. We have a presentation with Discovery Silver, which trades on the venture under the ticker DSV. With me, I have Taj Singh, CEO. He's going to go over the updated resource. For anyone that is brand new to the story, I would recommend watching some of the previous webinars on the Adelaide Capital YouTube channel, because this is really going to be about recent news. And yeah, as always, this presentation will contain forward-looking statements. If you'd like to know more about those, you can find them on the company's presentation on their website. And there will be a Q&A section to the session, so feel free to input your Q&A in the box at the bottom. Actually, I think most of the session will be Q&A, so feel free to start putting those in right away. With that out of the way, I'd like to introduce Taj. Hi, Taj.
Hi, Deborah. How are you?
I'm good. How are you?
Good, good.
So some exciting news out recently.
Yeah, and it was long awaited. It's been about a couple of years since we acquired the project, and we've been drilling all through the pandemic. Big acknowledgement to our Mexican team to keep doing that, to keep things going and safe for everyone. And yeah, we finally were able to put out this news, and then we've got obviously some very exciting news coming out in about a month's time as well. So exciting times.
Great. Well, why don't you give us a little bit of an overview of the updated resource, and then if anyone has any questions, we can start grilling you.
Perfect. Fantastic. So I'll just go over about 5-6 slides on the resource to give some context, because it is the news we're talking about now. And then, yeah, in the Q&A, I can flip to whatever we need to, depending on what we're talking about. Looking at our new resource, which was released last week, just going to talk about this first slide. It talks about the inputs and the assumptions that were used in the resource, and really the message we're trying to send here is how technically robust and defensible this model really is. So first of all, starting off at our data set, over 500 holes, close to 225,000 meters, so a very, very big data set reporting to the resource database. If you this is the first time geological and structural constraints were applied to the resource model. Previous model was a grade model, so again, that obviously increases the rigor of the model. Impressively, the waste-ore ratio is 1.1, so that's a very favorable characteristic of Cordero. Starts at surface, and it's got a very good strip ratio in the resource pit. The resource this is the first time as well that it was categorized in terms of sulfide and oxide and transition. Previously was all assumed as sulfide. We've done extensive met testing, relogged all the old 292 holes, I think it was, or something like that, to kind of, we have a full new interpretation of the geology of this deposit. So it allowed us to categorize, to profile to do an oxide profile, a weathering profile, which would include the oxides and transitions. So the sulfides are the main driver. We'll talk about it of the deposit, but the oxides and transitions have been modeled, and what's interesting is they actually show a lot of promise to be processed via heap leaching and provide potential early cash flow, which I'll talk about. So very interesting new positive add to the Cordero story with that. If you look at the pit constraint assumptions, our commodity prices are shown there, all realistic. Zinc's pretty low compared to what spot is now, but we tried to keep it realistic here. The recovery assumptions were based on 2021 MET program we did. Again, it was very extensive. The results were released on that in early September. And it was a very extensive program we did that was by pit phase, kind of conceptual pit phase based on our new ideas of where the pit would be, but also the 4 rock types in each of those pit phases. And composites were made from obviously a variety of samples. So speaking as a metallurgist and process engineer, I think the MET work was really something that might have been overlooked by the market. I mean, the stock went up a little bit, and then obviously silver came off and we got hit. But really, it was a major de-risking item for the project, probably one of the most important over the past couple of years. And the results were fantastic. We'll talk about those probably in the Q&A, so I won't get into it too much here. The mining cost, we assumed owner mining here. And again, speaking to the rigor of the model, we included an escalation factor per bench, which isn't very typical. But again, we wanted to keep things, very, very realistic. Processing costs were supplied by Ausenco. And you'll see here $630 per ton for mill and flotation. And the heap leaching costs here as well, that assumes 3-stage crush. And the G&A costs, again, were supplied by Ausenco based on their extensive database and obviously our project specifics. And the last point here, before I get into some of the numbers, is the fact that we use the net smelter return cutoff. Previously, Cordero's resource used a silver equivalent cutoff, which you'll see in gold deposits and single metal deposits. It's typical to use that. For a polymetallic deposit, we really thought net smelter return was more realistic. It's done by a lot of our peers, because it takes into account payability, treatment costs, and refining charges. So we applied that, and you'll see based on the costs they've shown above, the internal cutoff, and that is the cutoff to break even for processing and G&A, is for the sulfide, it's $725 a ton. So that's the sum of the processing costs and G&A. And for oxide, it's $478. So that's the typical industry standard on how to do the internal cutoffs. So that just kind of gives you an idea on things. Now, moving on to the sulfide resource, which again is the main part of the resource, the engine room of the economics as well. You'll see we reported a very, very large resource, over 1 billion ounces, both in measured, indicated, and inferred. But really, we also showed kind of the high grade subsets of this. So I'll talk about the high grade sulfide resource here. You're talking about close to 1 billion ounces silver equivalent at about a 46 gram per ton silver equivalent grade. Big positive, and was a bit of a surprise for us, is the fact that close to 90% of even this big resource is in the measured and indicated category. But if we move and look at a higher cutoff, look at a $25 per ton cutoff in terms of NSR, you'll see that in this high grade subset, you still have 60% of the contained metal of the whole resource is actually contained within the high grade subset. And that was our thesis when we started our journey on Cordero, that really a vast majority of the metal of this deposit is actually as a high grade open pit. And you'll see if you even increase it to $25 per ton cutoff, you're talking about over 500 million ounces silver equivalent at a grade of about 101 gram per ton silver equivalent. And so if you, depending on what gold to silver ratio you use, if you use 60-1, you're talking about, if you looked at it from a gold deposit point of view, something that's 1.5, 1.6 gram per ton silver gold equivalent at a very favorable strip ratio, that would be considered a high grade gold deposit. So that has to be put into context, that that's a very nice grade for an open pit with low strip ratio. Now, looking at growth opportunities, I mean, this is the sulfide resource. It's big. We actually think it can get bigger and better as we move towards a PFS next year. The opportunities that exist are at the far northeast of the deposit, which has had limited drilling, but very encouraging intercepts. So that's for the bulk tonnage. And a part of the story we've talked about is more on the exploration side, but moving more towards, moving maybe onto the next stage of the studies, these high grade veins, which we've been testing, defining the skeleton of them. And we'll continue to do that through 2022. But these high grade veins could potentially be a significant sweetener. They flank the open pit. And because all of the capex will be there, these could, especially in the early years, could substantially increase the head grades going to the mill. We'll talk about that, I'm thinking, in the Q&A. Looking at the oxide, again, the oxides only make up about 10% of the entire deposit. So again, sulfides are the key, but the oxides, what's really interesting for us is this was going to be waste, or basically stockpile material, because it can't be processed favorably using flotation. So this is the oxide and transition resource. You'll see at the cutoff of 484, you're looking at close to 100 million ounces at a grade of about 22, 23 gram per ton silver equivalent. Again, vast majority of it in measured and indicated, which is great. Now looking at the higher cutoffs, you see you got over 30 million ounces within this higher grade subset, and at a grade of close to 60 gram per ton. So again, translate that into a gold deposit, you're talking about a gram per ton or so. Heap leach would be a gram per ton gold heap leach would be considered high grade. And so this is very much, showing potential for early stage cash flow, which we're very excited about. This resource, it's important to note, only assumes gold and silver, because that's what's recovered in heap leaching. And we've done MET testing. The MET testing is outlined in the earlier release I talked about from September, which shows very good results at a variety of crush sizes. And we're also now underway completing column testing to confirm that. Things are looking encouraging there. Just to wrap up, I want to give you some context on the deposit. So this is a plan map. Look, the outline is in black here is the resource pit outline. You'll see the deposit can kind of be separated into the north corridor and the south corridor. And we've always kind of, when we talk about our results, we've always kind of talked about the north corridor and south corridor, separated by the Cordero fault, which separates it. And you'll see kind of the main areas of the deposit. Some other main faults are also indicated here, and those were important when we were outlining hard boundaries for our structural domains. But really, what we want to talk about is this in the next slides, we're going to be showing as long section A to A prime, which is in the north corridor, and B to B prime, which is in the south corridor. Looking at a plan map, you'll see that this is kind of the area which we're going to start at, the Poza de Plata area. They're the highest grades here, over 100 gram per ton for several years with the lowest strip ratios. Then you will move to the northeast extension. This is all for the sulfides. And then the third phase of sulfide mining would most likely be in the south corridor. The oxides would start in the south corridor. That's where we're seeing the best grades for the oxides and the most amount of oxide material. So if we look at this long section again through the north corridor, the blue is outlining the resource pit shell. The brown, solid brown indicates the topo, and the dashed line indicates kind of the weathered material above. And then obviously all the sulfides below. But you'll see, again, from looking at this long section, very favorable strip ratio. Again, very easy to see a nice starter pit here with some very, very juicy grades you can get right away. And then that's that Poza de Plata area. Then you step into this northeast extension, and then you start getting, you mine some of this material above, and then you start getting into some very nice high grade material down here. This blue pit outline is the resource pit outline. I want to make sure it's noted. The mine plan will be, different than this. It'll be a high grade subset of this blue outline you're seeing. So perhaps you come across here, pull this material, and most likely this material won't even make the mine plan. And that represents a potential growth opportunity as we drill it and or as silver price increases. But I want to note that the mine plan is really going to be focused on a nice high grade subset of the total resource that's really going to be trying to optimize financial metrics. If we look at long section B to B prime, that's through the south corridor. Again, you see very favorable strip ratios, but again, you get into this nice juicy stuff after getting some medium grade kind of stuff here. And you've got a very nice zone down here you can get into. For the sulfides and for the oxides, you'll see some very good grades up here for the oxides that you get into right away. So again, very, very favorable geometry from that point of view. So that kind of sums up the slides on the resource. So I'll kind of pass it back to you, Deborah, and we can take some Q&A.
Thanks for that, Taj. And if anyone from the audience has some questions, feel free to input them. I guess the first question I have is, when you first took over the company and the asset, you had a few ideas of how you wanted to develop it and what your thesis would be. I know you referenced it earlier, but maybe you could take us through kind of how that thesis is played out and how you've hit your objectives with drilling and et cetera with the resource.
This project, when we acquired it, the previous operator was Levon Resources, and they were really the kind of concept they had behind this was a very, very large tonnage project of lower grade. It's an earth moving operation, definitely makes money in the 20s. If silver falls below the 20s, it's challenging, and that's kind of what happened. The project was forgotten. And so we came in and we said, the original discovery days of this deposit, there were some very, very nice grades and very broad widths from the original discovery days of the deposit. So we focused on that Poza de Plata zone I talked about and some of the extensions around it. And we said, even if you've got something here, you've still got a very sizable project with very good open pit grades. And if we drill, let me just put up this plan map again. The focus was here. There was already very good grades here, but all here was very lightly drilled in the northeast extension, the south quarter lightly drilled, and there was some very good smoke there. It just wasn't drilled enough. And again, they were really just The previous operators wanted a size, so there was sometimes 200-300 meter spacing between drill holes. And we said, well, this area looks like you can hang your hat on it already. There was many very wide intercepts, over 100 gram per ton silver equivalent. And we thought that if we drill more here, we may get some, we may get the mineralization, the high grade mineralization to extend. And we did. We put almost 100,000 meters in it since then. And I'd say probably the high grade zone has probably increased in size about 4 times. So beyond what we really expected. And the model's been tightened up. It's a complete new look at the project. Strip ratios have come down, grades have come up. So all of these things are obviously going to favorably have an effect on economics. So really our thesis has played out, and it's actually gone beyond that, and the fact that the high grade zone has gotten so large.
And you've also been chasing down some vein systems. Can you talk a little bit more about those?
Yes, definitely. So flanking this kind of high grade pit area, you'll see that there was some high grade veins that were previously drilled before, but they weren't kind of tested as veins. They were just included in the pit. And we've been testing them as veins and modeling them as veins. And you'll see we've probably put about 25 to 30 holes, for example, in this Todos Santos vein trend, stepping out pretty aggressively and hitting every time. And we're getting, grades of, 600-700 gram per ton pretty consistently, sometimes over a kilo silver equivalent. And, we're getting, I think our average drilled width is about 2.1, 2.2 meters. And we've already traced this we've already drill tested 1.5 kilometers, and it's still open along strike. So like our thinking on this is let's really define the skeleton to see how far it goes. But if you can even put 4 or 5 million tons of this together, and it's grading, 20-25 ounce per ton silver equivalent, there's some serious high grade ounces you can add to the mine plan. And again, the capex, it's essentially starting at surface, these veins, so the underground development capex would be relatively low, and you've already had the capex from the open pit. You would supplement it with underground feed, and you'd be able to bring up those margins even further. Even if you mine this at 500 ton per day, or maybe moving up a little bit higher, it would substantially, because of the high grades, it would substantially increase the margins. So that's something we're going to be testing, and we think it could be a real sweetener to the project. It won't be included in the PA as veins, but potentially in the PFS next year, we'll be able to speak to those in the mine plan.
Okay. And where are you currently drilling? Phase 1 is completed and all the results went into the updated resource. You're in phase 2 now. Where are you targeting?
The key focus of phase 2 is obviously infill drilling, taking any inferred into the measured and indicated category. And we were a little surprised of how much is actually in the measured and indicated. And to be honest, most of the mine plan is going to be measured and indicated, probably all of it. But that was a focus for us. But now there's going to be extensions, like I talked about in the northeast, where we might be able to open up the pit and extend the pit here. And then we'll be working obviously on the veins. Those are the 2 key focus parts of our approach. And then obviously regionally on our land package, maybe I can just quickly go to that, but you'll see here's the kind of main resource area. There's already been several interpreted intrusive centers identified here. So we've already got reconnaissance teams doing quite a bit of work. And we think we're probably in a position to have 3 or 4 new targets to be drilled for next year. So that's earlier stage stuff, but obviously we believe this is a district, and we think the probability of finding another deposit could be high.
Well, that's interesting. When was the last time you did pure exploration on the property?
We've started pretty heavily in 2021 doing mapping and sampling. Quite a few areas we've mapped and sampled, but in late 2020, early 2021, for the first time, airborne mag and EM was flown over the property, which has helped a lot. We've done quite a bit of work on looking at alteration, footprints, etc., and kind of layering all the various types of information on top of each other to really focus in on the key targets. So we were really focused on the resource and the Cordero main area, if you will, but we're definitely going to start looking at some potential for some new discoveries property wide.
Okay, and maybe you can walk us through updated timelines for the PEA, for the feasibility study, and kind of what the news flow will look like over the next 6 months to a year. Perfect.
Yeah, perfect. I got this catalyst slide up, might as well put it up. So our resource drilling obviously finished at the end of Q2. That's what fed into the new resource, as well as the MET testing, which we talked about. Was both fed into the new resource here. The revamp PA is scheduled for late November-ish, mid to late November. And then the phase 2 drilling continued seamlessly as soon as phase 1 drilling ended. Again, the focus is on PFS and the veins. And then I talked about property-wide drilling in Q1. So there'll be a steady stream. Obviously, the major new catalyst coming will be the PEA, but drill results will continue to flow probably every month, every 3 to 4 weeks from our phase 2 drilling. And then hopefully in early 22, we'll be starting to talk about some new targets on the property. Yeah, and then we'll continue to de-risk with more MET work for phase 2, geotech work, et cetera. Those are all incremental kind of advancements in the project. We'll be obviously press releasing those through 22 as well.
And so you intend on doing a pre-feas or going straight to feasibility? I think this is something that we've discussed in the past.
Yeah, I mean, I think the engineer in me always says, don't miss a study. You got to do your PEA and your PFS and your FS, because the jump from PEA to FS is pretty substantial in terms of de-risking. But I will say, really, the project that's coming out, Cordero as a PEA, is really in most aspects a PFS. Like the fact that 90% of the entire resource is measured and indicated, the fact that the entire mine plan is measured and indicated, you know, this really is a PFS. So there's some discussion as to whether maybe we move to an FS right away, or we just, you know, within say less than a year, we put a PFS out. We can move to that quite quickly. You know, these are all discussions we've been having internally and thinking about it. Most likely, we will be putting out a PFS kind of halfway through 22, and then start moving swiftly towards an FS.
Okay, and since we're on the timeline slide, for anyone that's somewhat new to junior mining exploration development, maybe you can give us a bit of a timeline of, assuming that all the studies are positive and you continue to progress, like what would be a timeline towards construction and production?
Yeah, very high level. If the PFS comes out, say next summer, we could probably have an FS/construction decision by mid-23, third quarter 23. Start construction at that time, and then probably a year to year and a half after you'd have production. So late 24, maybe 25 is when you could have production. Now, if things really started moving, silver price environment got really hot, we probably could accelerate that. We've got a very healthy cash balance of over $75 million. So we really could accelerate that by maybe a few quarters, but that's the high level kind of timeline.
And I have an audience question, which is, what is the minimum silver price needed for this resource to be profitable?
Well, that kind of, that's why we've showed these cutoffs. So basically, if you look at this kind of resource at 725, you'd probably need kind of high 20 silver for this whole thing to be economic, realistically. If you did your math and where it looked at this $25 subset, it'd probably be less than $7, maybe close to $15 for this to be profitable, maybe even less. So that's, I think, going to be surprising for most people if they actually worked out the numbers and applied some cost. They'd realize that this high grade subset, actually, the legacy perception of Cordero is that it doesn't work at lower silver prices. I think that's going to be completely thrown out the window pretty soon, and we've been pointing to that. So I think this resource kind of shows that.
Well, I agree that you're definitely starting to get a lot of attention and recognition, and I think that'll continue when you come out with the PEA. I think this is a good time to talk about my favorite slide, which is your scalability one. Maybe you can walk us through a little bit of the dynamics of that.
Yeah, I know this is an interesting slide, especially for the silver bulls out there. But I kind of touched on it just now. But this kind of really shows the torque and the leverage we've got as silver price goes up. You've got your silver equivalent ounces here in all categories on the On the y-axis and on the x-axis, you've got your NSR cutoffs. You'll see at $25 per ton, that's that very high grade subset that again could work at very low silver prices. You've got, you know, over 500 million ounces total. Then you move, as you move to $15 per ton silver, you know, silver goes up in price. Now $15 per ton silver works. Maybe that's mid 20s, kind of high 20s. So all of a sudden you've added 140 million ounces. That's already there, drilled off, most of it in the measured and indicated category. You add 140 million ounces. Silver makes another run into the 30s. You've added another 150 million ounces already drilled off. And then as you start moving to the 30s, perhaps, like I said, you add another 110 million ounces. So it's very substantial, the kind of scalability we get. If you look at a typical silver mine, they're typically underground. This doesn't change regardless of cutoff. And the fact that we've got a high grade core, if you will, it's very sizable. So it's a little bit, calling it a core might be cutting it short, but it's a high grade core with a medium grade halo and a lower grade halo. We're in a very favorable position to continue to make this project larger and larger. And if silver price goes up, or even as CapEx is paid off, this project can get substantially larger. And that's, I think, very unique in the silver space. And this is only, by the way, I wanted to note the sulfide resource. When you add oxides, oxides also go up there. They're not as large, but if you increase your cutoff from 15 to, if you lower it from 15 to $5 per ton, you get an extra, 100 million ounces silver equivalent. So, I mean, goes to 100 million ounces. So, yeah, that's really what it's trying to show. The cutoff, when you can bring the cutoff down with silver price going up, you really add a lot of inventory.
Great. And when talking about size, I mean, that's one of the most appealing things in this company is just a massive project. Can you put that into context for anyone that may be new to the story? I think a lot of people are familiar with looking at gold, not silver. And yeah, maybe you can just frame it in terms of where it sits in like versus other assets or maybe versus gold companies.
Yeah, so we're, to put it in context, and we put this in the press release, and we've always talked about it, our numbers kind of 15 and 15. We want to have at least 15 years of mine life and target production of at least 15 million ounces of silver equivalent a year, with cash costs in the lowest half of the industry cost curve, whether it's, $10, $11, $12 cash cost, maybe AIC of 13, 14. That's kind of what our targets are internally. We've talked about that. So at 15 million, and remember, that's only the high grade subset I'm talking about. That's not the big project. That's not the big mega resource you saw. That's just the high grade project that we're focusing on now. If even with that, at 15 million ounces of silver equivalent, we would be probably number 6 or number 7 in terms of the largest primary silver mines in the world. When we expand that, because there'll be some years where we're well over 20 million ounces of silver equivalent, we go to 40,000 ton per day, which I can talk about in a second. We'd be in the kind of 25 million ounce per silver equivalent range. We'd be probably top 2 or 3 primary silver mine in the world. And to put it into context, some of the largest silver producers produce about 25 million ounces, 30 million ounces a year total across 5-6 mines. So this is all coming from one mine. So again, it really speaks to the size here. And again, all at a pretty digestible CapEx.
Well, looking forward to seeing some of those numbers in the PEA, which you said is going to be out towards the end of November.
Correct. Yeah. And maybe Deb, if I could mention one thing, you would ask the question of our approach versus the previous operators. This slide kind of sums it up. They really had a bigger is better approach, which I talked about. They were trying to make this kind of a Penasquito analog. It actually has a lot of similarities to Penasquito in terms of deposit type, mineralogy, precious metal content similar. They have more gold, we have more silver, but if you look at the total value, it's pretty similar. Base metal content similar. And obviously that was sold for billions of dollars. So that was kind of how the previous operators, their analogy, kind of what they were going for. They had, again, big throughput, cutoff, very low cutoff grade. I'd say that this 20 gram per ton silver equivalent cutoff grade kind of roughly lines up with an NSR cutoff grade of say the 7. The kind of our base case, or maybe a little higher, maybe 10. But again, for that, you need a huge throughput. CapEx is pretty high here, sitting at about close to $600 million. For us, it's a disciplined approach. Head grades I talked about, especially early in the mine life, looking at 100 gram per ton silver equivalent, high grade zones early in the mine life, really focus on that. And again, now you've doubled, tripled the head grade. You don't need a 40,000 ton per day mill straight away. You start at 15, 20,000 ton per day. Then once you've paid your CapEx off, you can expand to the 30, 40,000 ton per day. So that's our general thought. And CapEx, I spoke about it before, but we're targeting, hopefully for the sulfide portion of it to be around 350 to 400, and the heap leach part of it to be around 50. So I think, again, a very digestible kind of CapEx upfront.
Right. Well, I don't have any other questions. I don't see any from the audience. Taj, is there anything else that you wanted to discuss today in regards to the net results of the updated resource?
No, I think that's it. And again, if anyone has any questions down the road, please again feel free to reach out. All of our socials are up on our website, and you can contact us through that or through emails through Adelaide. But thank you very much for having us.
Yeah, thanks for going over the updated resource. Congrats. Looks good. And yeah, looking forward to seeing some more news flow. So thanks for presenting, Taj. And if anyone has any questions, feel free to reach out. And yeah, have a great afternoon, everyone. Bye.